Yo, what's up, fam? Hope everyone is well. Welcome back to Masterclass Day 5, I'm pretty sure. Today's lesson, we are going to be covering, this is actually going to be the part 2 of fair value gap. So if you haven't watched part 1, I definitely, obviously, highly recommend you go check that out before. But this is going to be the part 2 of fair value gap. So this lesson is going to be specifically covering how to actually use fair value gaps to or how to actually trade fair value gaps, some confirmations that we can look at when using fair value gaps to make sure that we are trading them as successfully as possible, because obviously fair value gaps aren't going to work 100% of the time. But I'm going to kind of give you guys some pointers on some things you should look out for and some things that would work better than usual. So let's go ahead and get right on into it. Like I just mentioned too, if you haven't watched Fair Value Gaps Part 1, that's pretty much just covering what fair value gaps are and how to actually draw them out. So if you're not familiar with that, 100% go and watch that video before you watch this. But let's go ahead and hop right on into it. In the previous video, in the slideshow that I covered, I had said that most of the time when I am marking out my fair value gaps, I'm either doing the 1 minute, 5 minute, and 30 minute. And realistically, especially, for the traders that know me, you guys know I'm pretty much always trading on the 1 minute. I'm always making my entries on the 1 minute. Therefore, I'm a lot of the times drawing my fair value gaps out on the 1 minute as well. For me personally, in the way that I trade, the trading style that I have, I've just seen 1 minute fair value gaps to work best for me. But very shortly, I'll kind of show you guys how we can switch it up and start to draw fair value gaps on higher time frames to also get that extra confirmation. You know what I mean? So here we are on the 1 minute time frame. Now, obviously, I have a couple fair value gaps charted out for you guys already. I have bullish fair value gaps and bearish fair value gaps, which I obviously covered in the last lesson too. There are two types of main fair value gaps. It's going to be the bullish fair value gaps, which are going to provide us with, large amounts of buying orders, pretty much kind of like demand, and then bearish fair value gaps, which are going to provide us with large amounts of sell orders, also that imbalance also being filled. Keep in mind, fair value gaps are also imbalances that are created. So market wants to shift towards those imbalances to fill that imbalance and obviously then move price to where they want to move it to next. So here, obviously, keep in mind too, fair value gaps are going to be created all of the time. So you're going to have many different, fair value gap opportunities, whether you want to take an entry off of it, whether you want to use the fair value gap to exit your position to make sure that you're exiting at the best point. You can use them really for anything. So first, let's start out with the bullish fair value gaps that I drew out. So obviously, fair value gaps are going to pretty much always be created on large moves, on sudden moves that are, presented within the market. So whenever we see a strong push to the upside or a strong move to the downside, typically that's when fair value gaps are created, supply and demand zones are created, etc. Also keep in mind, when price moves into supply and demand zones and they have moves from those zones, typically fair value gaps are going to be created from those zones. Because keep in mind, from those zones, large amounts of buying or selling pressure is likely to be inputted, and that's going to obviously cause price to move stronger, right, in either direction. And typically when price does move strong, when we have those strong pushes, that's what creates fair value gaps. That's what creates imbalances within the markets. Those imbalances also leaving unfilled orders within that area. So obviously market wants to make sure they shift price back to that imbalance to fill that imbalance and then continue moving price either back up or back down. So that's exactly what happened here. You guys can see, let me go ahead and get rid of this. You can see that we have a demand zone drawn out right here, this large push up. So I'm going to go ahead and mark this out, extend it. Let's go ahead and mark out the whole candle. Now you can see, boom, we got a first retracement into this demand, and then you can see we have a large push up. Right, you can also see on this large push up, we have a fair value gap created, just like I mentioned, right? Fair value gaps are pretty much always going to be created when price taps into our supply or demand zones, because, large volume is stepping in. So you can see fair value gap created right here, boom. boom, and then you can pretty much see that the fair value gap, or sorry, you can pretty much see that price tapped into the fair value gap almost a minute, almost immediately after that fair value gap was created. But what did we see most importantly? We saw that price was heavily holding up that fair value gap. We can obviously see multiple bullish wicks, indicating a reversal, right? Indicating that those buyers were starting to step in, buying pressure was starting to be inputted, right? Because rather than the selling pressure, right, you can see that those buyers were starting to become more active. Buyers were starting to hold price up, especially most importantly, just like I mentioned, these bullish candles, these bullish wicks. You guys have heard me say this too. Reading price action when price reaches our certain key levels is going to be very important. So you can see reading price action to the best of our ability. We see 3 bullish candles holding up this fair value gap very well. 4 bullish candles actually. 1, 2, 3, 4. And then you can initially see price absolutely continues back or has a strong push back to the upside. Obviously we reversed there, but I'm going to teach you guys how we can best trade with fair value gaps. Just a quick little pointer is, let's say we are taking this entry off the fair value gap. Yes, it is going to be a pretty quick scalp, but realistically what I would do is I would just target the previous highs from when that fair value gap had the move. So obviously we have the move here into the fair value gap. So we want to target the previous highs. So either this high right here or this high right here. So you can do, let's say we mark out this high right here. Now, boom, perfect. Price taps into that high. That's where our take profit is. We take profit at the perfect point possible, and then price continues to move back to the downside right there. So keep in mind, fair value gaps are not always going to present us with the craziest moves possible, but they will present us with a move to where we can trade it. You know what I mean? To the point where we can be able to catch some sort of solid trade. But that's why taking profits is also very important as well. So there's that. And then also, another thing that I want to mention as well is I want you guys to go, when you're on TradingView, you go to your third option right here on the top left. You guys should be able to see, yeah. So 1, 2, 3. So you're going to click on this little arrow here, and you're going to go all the way to the bottom where it says Gone Box. We're going to go ahead and just, boom, extend this out just on our charts. And when you do have this extended out, you're going to go to the top where it says Settings here. You're going to go to Style, and I want you guys to only mark out 0, 0.5, and 1. Those are only the ones that I want you guys to have marked out. And then for time levels, only 0 and 1. Okay? So pretty much just copy exactly what I have here. If you'd like, you can change the colors or whatever the case may be, but this is what I want you guys to start with. So now that we have our Gone Box, this is kind of going to be a barrier for a fair value gap, or kind of like a level within our fair value gap. So now that we have this marked out, what we want to do is we want to get our Gone Box and we want to mark it out with the whole shape of the fair value gap. So literally mark out the whole fair value gap with our Gone Box, make sure it's like pretty much perfect. So boom, boom. And then literally try to make it as perfect as possible. So boom, perfect. So for the reason that we have this Gone Box, let me get rid of these arrows here. So when price taps into our fair value gap here, with the Gone Box, we want to keep in mind that we want to use this 0.5 area, meaning the half point mark within the fair value gap, as our main entry point. Right, as our main entry point, if price hasn't already reversed from the fair value gap, right? So let's say that price taps into the fair value gap and we don't see that initial reversal. We want to wait till price taps into this 0.5 mark, which is the halfway point of the fair value gap, to actually understand if we will get that initial reversal from that fair value gap. Now, let's say that and you guys can see exactly here, we tapped into that 0.5, and that's when price started to push back to, where the hell did we go? Oh yeah, right here. You can see we tapped into the 0.5 exactly right here, and once we tapped into the 0.5, you can see what happened. price just continued to push heavily to the upside. Now let's say that price tapped into the 0.5, but it continued going lower than the 0.5 mark, and it even closed under the 0.5 mark. Then that should kind of be something for us to step away from that fair value gap, to understand that that fair value gap is likely to not be as active or likely to not be as strong as we think. You know what I mean? So we need to always use that 0.5 mark as either an entry area or as just simply a area to understand where price is likely to reverse from. And if it does not reverse from that area or anywhere close, then like I said, we should start to step away from that fair value gap and likely not trade it, because that fair value gap doesn't have the highest chance of presenting us with the move that we are expecting. So keep in mind, anywhere at that 0.5 mark or below, or slightly below, not below, slightly below is where we want to use for our entry. But also keep in mind, let's say that it kept pushing below the 0.5 mark, and let's say that it even closed below the 0.5 mark. Let's say that we had a 1 minute candle close under this 0.5 mark while still trading within the fair value gap. That should also kind of give us, that idea to step away from that fair value gap, because it's not likely to provide us with that move. So another example of this gone box working out is, keep in mind the gone boxes are going to pretty much work the same, but it's going to be slightly different with bullish and bearish fair value gaps. But you guys can obviously see here, bullish fair value gap created. You guys can also see that demand zone that I created here. We got our third retracement into this demand. And like I also mentioned, when we typically tap into supply or demand, fair value gaps are created. That's exactly what we had here. Tap into demand, fair value gap got created. Shortly after, a couple minutes after, we tapped into that fair value gap, and you guys can pretty much see right at that 0.5 mark, right at that halfway mark, it heavily respected it, and that's initially where we had that huge move, huge push to the upside, right off this demand, right off that fair value gap. Same thing here. Look, fair value gap created, pretty much a little bit above from that fair value gap I was just explaining. Fair value gap created. You guys can obviously see here, gap between these candles. The candles are not overlaying. But that's in lesson 1, so we're not going to be covering that. But you can see, obviously, price taps into our fair value gap, and right at that 0.5 mark, look what happens. We heavily respect it, heavily reject it. It's like a key level inside of our fair value gap, right? And at that 0.5 mark, that's where price starts to continue up higher to the upside, right? But obviously, like I mentioned, let's say that price starts to push below this 0.5 mark, push below that halfway mark, and not respect that 0.5. We should start to step away and start to not really look to trade it anymore, because it's not likely to be active. Now, that's not going to be 100% of the time, but that's likely going to be the case if it does disrespect our 0.5 mark within that fair value gap. So keep that in mind. So those are like multiple different examples of how we can use the gone box. Obviously, look, if I were to just draw it out, keep in mind, we just grab the gone box, mark it out within the whole length of our fair value gap, and then boom. So there's that, and then you can obviously see 0.5 heavily respected. And if we were to okay, so let's go over, here's this too as well. We have a bearish fair value gap. So I was covering bullish fair value gaps, so now let's cover bearish fair value gaps, which are just completely going to be the opposite. So we can obviously see tap into supply. Like I also mentioned earlier, whenever we tap into supply zones or demand zones, fair value gaps are going to be created. I actually took this trade. This was such a beautiful trade. But tap into supply off this 5/12/45. You can see strong sellers initially stepped in. What happens when strong sellers step in? That then creates strong selling momentum within the market. And then you can obviously see we have a strong push to the downside. And then you can also see a gap being created within these two candles. Like I also mentioned last lesson, fair value gaps typically consist of a 3-candle move. So 1, 2, and then 3, this candle. But keep in mind, this black candle and this black candle, they're not touching each other. You see the gap between both of them. They're not overlaying how all of these candles are. So if we go to this fair value gap, and then get our gone box out, and then just extend, make sure it's as perfect as possible, like I mentioned. And then we want to just extend that baby out. So boom, boom, boom. Okay, cool. Now look at that. We extended it out. Price finally retraced into our fair value gap, heavily respected that 0.5 mark, and sellers started to step in. Keep in mind, for our take profit area, typically where I'm looking to take profits or take my main profits and then hold runners, is going to be the previous lows or previous highs, depending on which fair value gap we're trading off of. So we're trading off of a bearish fair value gap, so we want to look for the previous lows. So right here, these previous lows, we can also see pretty strong resistance being created right here. So we mark that out, and then you can obviously see perfectly taps into our, sorry, I meant support, not resistance. Perfectly taps into our support here, and then price continues to reverse, bounce off that support, and continue back off to the upside. So boom, tap into that fair value gap. We're targeting the previous lows, perfectly taps into our take profit, perfect trade off that fair value gap. And you can also see here the 0.5 mark, perfectly respected, right? But if it wasn't respected, like I said, if it starts to push up above the 0.5, it's going to be a little bit different since this is a bearish fair value gap. If it starts to push above the 0.5 and disrespect the 0.5 on a bearish fair value gap, then that should also give us the idea that we should start to step away, right? Because that means that those buyers are really starting to actively be in control in that bearish fair value gap, which is something we don't want. So there's that, but you can obviously see it respects the 0.5, but let's say it does close above the 0.5. If we have a 1 minute candle close above the 0.5 or a 1 minute candle close above the 0.5 on a bullish, then also, like I said too, that should give us, the idea to step away from that fair value gap. Unless we do really start to see those buyers or sellers actively stepping in within that gap. But other than that, if it does disrespect the 0.5, depending on which type of gap we're trading off of, then we should really start to step away. So that would be that. And then in terms of stop losses, it's pretty much just going to be the same thing like how I do my supply and demand zones. I'm just doing a break or an invalidation above or below my zone. So this is also going to kind of be solid with the fair value gaps because most fair value gaps are going to be pretty like thin, like these. So let's say we're entering at the 0.5. Stop loss is a break under the fair value gap, targeting the previous highs, or you can target up here, or let's say you target the previous highs and then you target this doesn't even make sense. You target your previous highs. When you get to the previous highs, you take a chunk, like a large chunk of your position out. You take your main profits, and then when you take your main profits, that's when you leave your runners to continue running back to the upside. Sorry, I had a little situation there. I couldn't even explain what was going on, but little stutter situation, but we're good. All right, cool. So there's that, and then obviously you can see the stop loss. Your risk is just completely minimized. And then same thing if you were trading off of a bearish fair value gap, you can do this to the downside, enter at the 0.5. What the hell happened? Enter at the 0.5. Stop loss at a close above that fair value gap, target your previous lows, boom, take profit, perfectly hit right there, right? So there's that. So beautiful trades off of these fair value gaps. And then let's find an example of a fair value gap not working so we can kind of understand what to do or what to look for when, fair value gaps are going against us. So let's see, we have a bearish fair value gap. 1, 2, 3. We have a bearish fair value gap created here. So let's go ahead and get our box. Okay, bearish fair value gap created here. You can see price tapped into our bearish fair value gap. Now let's create our gone box out. So rather than going into our fair value gap and continuing back like this, like going onto our fair value gap and then continuing back to the downside, you guys can obviously see that we moved into the fair value gap, disrespected the 0.5, closed above the 0.5, which, like I said, if we start to do that, that should give us the idea that that fair value gap isn't going to be as active for us anymore. That's pretty much exactly what we did. We closed above the 0.5, we heavily disrespected the 0.5, and then we broke above that fair value gap. So that's pretty much what you should look for, when price is starting to, or what you should look for when you should really understand when the price is going to actually invalidate your fair value gap or not, if you know what I mean. So that's going to be that. And then also you can also pretty much see, like I mentioned earlier too, multiple times, you want to read price action when it actually retraces into your certain zones, or when it moves to your key levels. So in this case scenario, you can see that price moved into our fair value gap, but look what happened, or look at price, look at the candles while it was trading inside of our fair value gap. We got a strong push up showing strong buying pressure. We invalidated that 0.5, continuing to show strong buying pressure, and we were getting bullish wicks, bullish candles, signs of bullish buying pressure being inputted, right? Multiple times. And those buyers were holding this level up, holding price up, right? We were continuing to make higher and higher and higher highs. And that's initially what led price to breaking through that fair value gap, because buyers were simply just too strong, leading into that bearish fair value gap. And that's going to happen sometimes. Because also, like I said earlier too, these fair value gaps aren't going to work 100% of the times. But if you kind of mix your confirmations as best as possible, then, you can be a sniper, literally. So that's going to be that. And then last thing that I do want to cover is if we switch over, let's say we switch over to the 5-minute time frame, right? Let's switch over to the 5-minute time frame, and then let me zoom out here. Okay, so now that we're on the 5-minute time frame, this is going to be a perfect example. So here, this was actually the example that I showed you guys earlier on the 1-minute, right? So if you can draw a fair value gap on multiple different time frames, and those fair value gaps match up within the same area, that should also give you extra confirmation, because it's telling you that's really where that imbalance is. That's really where those, extended amount of unfilled orders are. So if price does shift back to that area, which it very likely will, price is very likely to have that move, that significant move from that specific key level. And in this specific case, that key level is going to be our fair value gap. So we can obviously see here, this fair value gap with the gone box is our, let me get rid of the gone box, is our 1-minute fair value gap. But we can also see here, we have a 3-candle move, 1, 2, 3. Fair value gaps typically consist of a 3-candle move. So on that 3-candle move, we can also see a fair value gap being created on this 5-minute time frame. Keep in mind, we're not on the 1-minute time frame, we're on the 5-minute. So we can obviously see a gap being created between this candle and this candle. So we mark that out just how we would do on the 1-minute. Boom, boom. Now you can see that our 5-minute fair value gap is pretty much mixed into our 1-minute fair value gap. They're pretty much in the same exact area. So now let's mark our gone box on our 5-minute fair value gap. Textbook. You guys can see how beautiful that works. Also too, let's say that, let me draw the gone box on the 1-minute. It's a little bit confusing now that we have 2 gone boxes, but you can see this 0.5 mark is heavily respected, right? That's pretty much initially where we had that move, that reversal back to the upside. So you can see we mixed the 1-minute, mixed the 5-minute, and we had that strong, nice, beautiful push to the upside. But that's going to be that. That's going to wrap up this fair value gap part 2 lesson, masterclass day 5. Hope you guys found some value from it. If you guys have any questions, shoot me a message, text me on Discord. You know where to find me. Other than that, much love. I'll see you guys soon.